By the end of this video, you'll understand why the hottest investment of the decade might be the biggest trap since 2008, and why almost nobody is talking about it. Meet our friend. He's a regular guy, works hard, pays his bills, takes care of his family, and like millions of others, he's been hearing one word everywhere lately: AI. His coworkers won't stop talking about it. His boss mentions it in every meeting. Even his neighbor bought some AI stock and won't shut up about it. So one evening, after putting the kids to bed, he opens his laptop. He sees the headlines. AI companies are making billions. Stock prices are going through the roof. Everyone seems to be getting rich. And that little voice in his head says, maybe I should get in on this too. But here's where it gets interesting. What nobody told him, what nobody tells most people, is that we've seen this exact movie before, multiple times, and it never ends well for regular folks like him. Let's rewind, way back. The year is 1999. The internet is brand new. Every company with a .com in its name is worth millions. People are quitting their jobs to trade stocks. Your taxi driver is giving stock tips. Sound familiar? Companies with zero profits were valued at billions of dollars. Why? Because the future was unlimited. The internet would change everything. And it did change everything. But that doesn't mean every internet company was a good investment. In fact, most of them crashed hard. By 2002, the .com bubble had wiped out almost $8 trillion in market value. $8 trillion! That's more money than most countries produce in a year. Regular people lost their retirement savings, their kids' college funds, their homes. But wait, the internet did become huge, right? So why did people lose money? This is the part most people don't understand. Being right about the technology doesn't mean you're right about the investment. Let me say that again. The technology can be revolutionary, world-changing, and you can still lose your shirt investing in it. During the .com boom, there were hundreds of search engines. Only one Google survived. There were dozens of online bookstores. Only Amazon made it. For every winner, there were 99 losers. And here's the scary part. Even experts couldn't tell which companies would survive. Now, fast forward to today. AI is everywhere. ChatGPT, Claude, Gemini. Every company is suddenly an AI company, just like every company was suddenly a .com company in 1999. Our Fox friend sees his coworker bragging about his AI stock gains, triple digits in just a few months. It feels like everyone is making easy money. So he takes some of his savings, money he was putting aside for a family vacation, and he buys into an AI fund. The first week, he's up 15%. This is amazing. Why didn't he do this sooner? The second week, up another 10%. He starts thinking bigger. Maybe he should put in more money. Maybe he should tell his wife. But then something happens. One morning he wakes up, checks his phone. His stomach drops. Down 12% overnight. One company missed earnings expectations. Another announced layoffs. The whole sector is falling. He tells himself it's fine. It's a correction. It'll bounce back. But here's what he doesn't know. Behind the scenes, there are some serious problems brewing in this AI boom. Problems that most regular investors never hear about. First problem, most AI companies are not making money. This sounds crazy, right? These companies are worth hundreds of billions. But here's a dirty little secret. Running AI systems is expensive. Every time you ask ChatGPT a question, it costs money. The electricity alone is massive. We're talking data centers that use more power than small cities. And right now, most AI companies are spending way more than they're earning. They're burning through investor money hoping that profits will come later. Sound familiar? It should. That's exactly what .com companies did. Second problem, the hype is outrunning the reality. Yes, AI is impressive. Yes, it can write poems and create images and even code software. But can it consistently make businesses more profitable? Many companies are struggling to figure out how to actually use AI to make money. They're spending millions on AI tools, but the return on that investment, unclear. One study found that most companies adopting AI haven't seen any productivity gains yet. They're spending money on something that might pay off someday, maybe. Third problem, competition is brutal. Remember how there were hundreds of search engines before Google one? The same thing is happening with AI right now. OpenAI, Google, Microsoft, Meta, Amazon, Apple, plus hundreds of startups, they're all fighting for the same market. And in a fight like this, most companies will lose. The question is, which ones? And does our Fox friend own shares in the winners or the losers? He has no idea, neither do most investors. Fourth problem, the easy money has already been made. When early investors bought in, these stocks were cheap. Now they're priced for perfection. The prices already assume everything will go right. But what if it doesn't? What if growth slows? What if competition heats up? What if regulations kick in? When you buy at the top, you need everything to go right just to break even. Our friend starts to worry. He checks his portfolio constantly. Every news headline makes his heart race. His wife notices something is wrong. He's distracted at dinner, can't sleep well, keeps checking his phone. This is what happens when people invest money they can't afford to lose. But here's the thing. This isn't just about AI stocks. This is about a pattern that repeats throughout history, again and again and again. Railroads in the 1800s, same thing. Railroads were revolutionary. They changed America. But most railroad companies went bankrupt. Investors lost fortunes. Radio in the 1920s, same thing. Radio was amazing, changed entertainment forever. But most radio company stocks crashed. Cars, planes, the internet, crypto. Every major technology follows the same pattern. First comes excitement, then hype, then mania, then crash, then, slowly, the real winners emerge. The technology usually does change the world, but most early investors don't make money because they pick the wrong companies, the wrong timing, or they panic sell at the bottom. So, what should our Fox friend do? Step 1. Don't invest money you can't afford to lose. That vacation fund? Bad idea. Money you need in the next 5 years? Bad idea. His kids' college savings? Definitely bad idea. The stock market is a place for money you won't need for decades, not money you're counting on. Step 2. Diversify. Putting all your money in one sector is gambling, not investing. It doesn't matter how promising that sector looks. Smart investors spread their money across different types of investments: stocks, bonds, real estate, different countries, different industries. This way, when one thing crashes, and something will always crash eventually, you're not wiped out. Step 3. Ignore the hype. When your coworker is bragging about gains, that's often a sign you're late to the party. The best time to invest is when nobody's talking about it, not when it's on every news channel. The old saying is true: be fearful when others are greedy. Be greedy when others are fearful. Right now, people are very, very greedy about AI. Step 4. Think long-term. Even if AI does crash tomorrow, it doesn't mean AI is dead, just like the internet didn't die after the dot-com crash. The companies that survived 2000 went on to become the biggest companies in history. Google, Amazon, they emerged from the ashes. The same will happen with AI. Some companies will survive and thrive, but picking which ones? Nearly impossible right now. Step 5. Index funds are your friend. Instead of picking individual stocks, consider index funds that own hundreds of companies. You won't hit a home run, but you also won't strike out. Over the long term, diversified index funds have beaten most professional stock pickers. Let that sink in. Regular people with simple index funds beat the experts. Our Fox friend starts to realize something important. He got caught up in the excitement, the fear of missing out, the dream of easy money. But real wealth isn't built on hot tips and trendy stocks. It's built slowly, boring way, a little bit every month for decades. His parents didn't get rich by picking the right stocks. They got comfortable by saving consistently and not taking crazy risks. He takes a deep breath, makes a decision. He sells half his AI position, puts that money into a diversified index fund, keeps a small amount in AI, Because yes, it might still do well, but now it's money he can afford to lose. More importantly, he stops checking his phone every 5 minutes, stops reading every headline, stops letting the market control his emotions. Because here's the ultimate truth about investing. The market will go up, and it will go down, sometimes for years at a time. This is normal. This is expected. The people who win are not the ones who pick the best stocks. They're the ones who stay in the game long enough, who don't panic, who don't chase trends. They're boring, they're patient, and slowly, very slowly, they build wealth. Our fox friend goes back to his normal life, makes dinner for his kids, plays catch in the backyard, goes to work. He still reads about AI sometimes, still thinks it's interesting technology, but he's not letting it control his life anymore. Will there be an AI bubble that pops? Maybe. Probably, honestly. Will AI still change the world? Almost certainly yes. But those are two different questions, and understanding the difference is what separates smart investors from people who lose their savings chasing the next big thing. So, what about you? Are you investing based on headlines and hype, or do you actually have a plan? If this video made you think differently about your money, hit that like button. It helps more people see this message. And if you want to learn more about protecting your money from the next crash, subscribe and hit the bell. We break down complex financial topics every week in a way that actually makes sense. Because in the end, the best investment you can make isn't in any stock, it's in your own financial education. Stay smart out there. Don't chase bubbles. And remember, boring investing beats exciting investing almost every single time. See you in the next one.